Under amortized cost measurement, the value of the asset is recognized on the balance sheet at cost, so essentially at the value that the entity paid for the asset. In addition to this, a nuance under amortized cost measurement is that the transaction costs incurred in obtaining the financial asset are also included in the value of the asset on the balance sheet, i.e., the costs are capitalized to the financial asset. These are then amortized over the life of the financial asset, hence the name amortized cost. Let's look at an example scenario. In this example, the entity has spent $1 million for a debt security bond on January 1st of the first year. This bond has annual interest receipts of 5% paid on 31st December of each year. The term is 3 years with the principal repaid at maturity. The effective interest rate is 4.2755%. Transaction costs of $20,000 were incurred in obtaining the debt security. The entity has made the accounting policy choice of accounting for this instrument at amortized cost. The most important thing to note is that this asset has been designated as being valued at amortized cost. This means we need to consider the transaction costs in addition to the cost of the asset for what should be recognized on the balance sheet. We note that the entity spent $1 million for the asset itself, which means we must recognize $1 million attributable to the asset on the balance sheet as this is what has been invested. In addition to this, $20,000 in transaction costs have been incurred, which we can simply add to the amount recognized on the balance sheet in line with accounting at amortized costs. This gives us a total value of the financial asset on the balance sheet of $1,020,000. We can post our journal to recognize initial measurement as such, a debit to the balance sheet to recognize the asset at the calculated value of $1,020,000 along with a corresponding credit to cash or payables equivalent to the same amount, as this is what has or will leave the bank account as total cost of this asset, the asset itself and related transaction costs. The best way to manage subsequent measurement is by preparing the amortization schedule. The initial measurement gives us the starting point. From there, we can consider the interest receipts, interest accrued under the effective interest rate method, impairment, and principal repayments each period, all of which give us the closing balance for the period. This then becomes the opening balance for the next period until we reach the end of the financial assets term. We can start with the initial measurement as calculated prior. We know from the scenario facts that $50,000 of interest is receivable each period. This is the cash amount received through holding the instrument. We can then calculate the interest accrued based on the effective interest rate. Without going into too much detail, this is essentially the amount received as cash interest from the instrument, with an adjustment to it being an amount of amortization of the transaction costs. We can then consider any impairments recognized during the period. Under this scenario, there are none. We can then consider principal repayments. In this scenario, there will only be one in the third and final period. With this prepared, we can determine all of the journal entries that we need to post each period. Journals can be posted based on the schedules prepared. As an example, the first period is shown. Each period, receipt of interest from the instrument is recognized through a debit to cash or receivables if accrued and actually received in the next period, i.e., not on 31st December, rather in January. The other side of this is split between interest income and the financial asset. The amount of interest income credited here is not the same $50,000 received, rather the amount based on the effective interest rate. This is slightly less than the $50,000 because it contains an amount of amortization of the transaction costs. The difference between the cash interest recognized and the interest income calculated using the effective interest rate is credited to the financial asset, given it reflects the amortization of transaction costs. This is recognized each period until the third and final period, which an additional journal is posted recognizing the receipt of the principal repayment. For the principal repayment, cash or receivables is debited, with the other side crediting the financial asset at its cost value, i.e., not including the capitalized transaction costs. As mentioned prior, these transaction costs were amortized over each year. And with that, we have appropriately accounted for a financial asset at amortized cost under IFRS 9 financial instruments. Thank you for watching. If you found this video helpful, please like, subscribe. Feel free to comment any topics you would like to see addressed in future videos. Check out financialreporting.wtf for more content and resources. See you next time.